areas. How long will this be the minimum wage for Amazon? At what point do you anticipate need?
Lots of different fires burning in India, some small, some not so small. The currency is down 12% for the year. The credit markets are a touch edgy. Liquidity has tightened. Now, in the old days, the RBI, a full-service central bank, would have toggled its objectives to balance out the pulls and pressures. Today, in a monetary policy committee regime, maybe the flexibility is relatively limited. So how should the MPC look at the environment in the economy and in the markets, and what should they do? Joining us to talk about that is Sajjid Chinoy, Chief India Economist at JP Morgan, and Ananth Narayan, Professor at SP Jain Institute of Management. Thank you both so much for taking the time to speak to us here on Bloomberg Quint. Sajjid, I'm going to start with you. We have a growth inflation mandate for the MPC, but we are not in a classic growth inflation problem. We've got a whole heck of other problems which may feed into those indicators. How will the MPC react? But before that, how will they analyze the problem?
Thanks, you're right. I think rarely can I remember an MPC meeting where there are so many different cross currents, and this is not unique to India. I think other emerging markets are also facing the same thing. What are these pressures and pulls? Well, since the last meeting, crude prices are up almost 15%. The currency has weakened almost 7%. So that's going to put some pressures on inflation going forward. Our own sense is, the RBI has to be forward-looking. Between January and June of next year, we expect inflation to be upwards of 5%. So that itself is the challenge they have to confront. But having said that, the negative terms of trade shock from higher oil prices and the fact that monetary conditions have tightened in the economy in the last few months, as it has in other emerging markets, also means that growth impulses are going to get softer going forward. And then you've got financial stability concerns emanating both from the risk if the rupee depreciation were to accelerate or get disruptive, which is not our base view, but if that were to happen, that creates financial stability concerns. And on the other hand, India's got a shadow banking system which we've seen has become fragile in recent weeks. So if credit conditions tighten there or liquidity freezes, that creates its own set of financial stability concerns. So there are lots of moving pieces here. But I will argue, Ira, that the current framework that the RBI adopts, the flexible inflation targeting framework and their liquidity framework, is enough to balance out these pushes and pulls. And I'll explain briefly why. It's just at this point in time, there's enough macroeconomic uncertainty in the world. We don't want to compound that with policy uncertainty. So we should stick to what's been working. Under their inflation targeting framework, interest rates, in my view, will have to go up. We expect on Friday the RBI to raise rates by 25 basis points and potentially even change their stance. So that will help confront inflation, and that will also at the margin help temper aggregate demand and therefore bring that current account deficit, which is unsustainable, hopefully a little bit more under control. But they have a liquidity policy which is well laid out as well, that that you want to keep headline liquidity at neutral and you want to confront durable outflows with durable injections. Basically, given the pace of FX intervention and the pace at which currency in circulation has been withdrawn from the banking system, we had anticipated a long time ago that there'll be a large quantum of open market operations. And we've seen that in the last month. The RBI has done a lot of OMOs and announced a calendar for October. And I think that continues in the next 4 or 5 months to meet its liquidity objective. Those OMOs will, I think, soothe some of the stresses in the shadow banking system. So I don't see a conflict here. I believe that if you keep raising policy rates, given your inflation objective, but also do some OMOs at the long end to meet your liquidity objective, you can try and reach this balancing act.
Okay, and I'll talk about some of those specific aspects. But Anand, the same question to you. You had a piece out in the morning where you said the short answer is that legislative mandates cannot overturn basic economics. But what's the long answer behind that suggestion or that advice to the MPC?
Well, the MPC is clearly constrained by what the legislative mandate is. But let's keep that mandate aside for a time being. And let's look at the overall situation in the market. Clearly, there is an issue of financial stability. On the external sector, we have an imbalance where we know that the current account deficit has become extremely large, and we're going to see permanent outflows across the current account deficit and FDI, maybe to the tune of $50 billion this year. Second issue, there is an overhang of unhedged currency exposures which have been built up in this country. Between FY15, fiscal year 15 and fiscal year 18, I make out about $120 billion of unhedged exposures which have been built up in the country. This includes FPI in debt. This includes rupee deposits brought in by NRIs. This includes net exporters selling because the forward premium was high. And most of this came in because the real interest rates offered by the country were high. So you have this overhang of unhedged exposures lying in, and there are permanent outflows going out as well. And if $50 billion of these unhedged exposures get covered during the course of the year, put together with the permanent outflows, we're looking at $100 billion of outflow. Second problem is the state of the financial services industry, and enough has been discussed about it. Banks are still struggling with NPAs. Now the shadows being cast on the NBFC and housing finance corporations, as Sajjid mentioned, and the overall ecosystem is looking quite brittle. The third part is of course, the fiscal side. While the finance minister has categorically said that he will maintain the fiscal deficit discipline and ensure that capital spend is not cut, the math just looks incredibly difficult. Put all these three together and we are in a bit of a spot when it comes to financial stability. Now, of course, you would like to cut rates and give relief to the financial sector, the second point that I mentioned. But that's just not tenable at this moment because of the nature of the currency situation that we're facing right now. We've seen what has happened, Ira, in various countries around the globe, which have looked like being soft on monetary policy. The moment you lose that credibility on monetary policy, you will see a run on the currency. This is not about hiking rates to try and build a currency defense. This is merely being as credible as possible to avoid a hemorrhage. So long and short answer is that we have a financial stability situation. At a time like this, we cannot afford to be lax or see behind the curve. We cannot afford to have demand go up. We have to curtail demand both fiscal side as well as through interest rates. It is unpalatable, it is dirty, it is not nice to hear. But if you have high demand at this moment, you are going to stress your external sector with higher imports. So that's the long and short of it. And in the meantime, we have buffers. We have $400 billion of reserves. We can draw on other ways of unconventional ways of raising dollars. We've got to use all those buffers and buy ourselves some time and address the core issues. Current account deficit has to be addressed. The state of the financial services system has to be addressed. Fiscal quality of the fisc has to be addressed. But that's the important two-step process. One is manage the current situation and sentiment, and then address the core issues. So the monetary policy framework will not count for any of this, right? It'll look at the inflation outline, which is kind of sad. But I'm hoping that they come with a contortionist Excel spreadsheet, which tells you that inflation is going to be very high in a year's time, and therefore, justify a hawkish policy.
Contortionate Excel spreadsheet, that's a great word. But Sajjid, okay, let me start tackling each of those elements first. Let's start with the currency and the current account. Now, how do you think the MPC can analyze the current account? Should they get into the debate about savings investment gap? Should they get into the debate, which I think Niranjan Radhadaksha pointed out in his article today, of looking at a growth rate which is consistent with a current account deficit, which is sustainable? Should the MPC even go in that direction? Will it?
No, I don't think it will, and I don't think it should. I mean, this is precisely why we wanted to get away from the multiple indicator approach, because that just increases policy uncertainty. Do we want to get into a guessing game where, in every policy we're guessing what the new objective function is going to be? One policy, it'll be inflation, the next policy growth, the third policy currency, the fourth policy financial stability? No, I think that just increases risk premia and will confuse economic agents. I don't think there is an inconsistency here. That's my point, that when you have imbalances in the country, the current account deficit is simply reflecting imbalances, that investment is higher than saving. Those imbalances also get reflected in core inflation. So by tackling core inflation and headline inflation, you are indirectly also tackling external imbalances. So what I'm suggesting is there have been enough inflationary pressure or impulses since August for the RBI to remain orthodox and say, the framework we've been following for the last year has been, let me project one-year inflation ahead and act accordingly. If we project inflation to the first half of 2019, with oil at 85 and the rupee at 73, and both risks to the upside now, because none of these pressures are going to abate globally. I mean, the tariff wars are getting worse. with Iran out of the market, most people expect oil prices to be higher, and we now know that the Fed is very much a force in motion. They've got to do 3 or 4 more rate hikes just to get to the Fed's own definition of neutral at a time when they really need to be in restrictive territory. So none of these pressures are abating. So my sense is 1 year ahead, our own forecast, our inflation is comfortably above 5%, and that gives the RBI the license under its existing framework to raise interest rates in October and perhaps more, and that will have a depressing impact on the current account over time. I'll just make one final point that, you know, this adjustment process cannot be concentrated on any one instrument, otherwise that instrument will overshoot. It has to be absorbed across multiple instruments, the exchange rate, monetary policy and fiscal policy, and I think Indian policymakers are doing the right thing. That the rupee has absorbed some of the pressure, interest rates have gone up and will go up, and the government has said, at least at the center, we'll make sure that the fiscal deficit is met this year. It's the combination of these things that will begin to bring that current account down from unsustainable levels.
Okay. Ananth, so if one goes down that line of thinking that Sajjid highlighted, so, one can have higher interest rates. And as you were earlier saying, one can keep pumping in liquidity to ensure there's no shortage of liquidity. The cost of liquidity is a separate issue, and it may not be ideal for NBFCs. It may not be ideal for banks. But that could be a balance that they could maintain without actually putting a question mark on the objectives of the MPC or anything, because those are 2 separate functions, right? The MPC does rates, the RBI does liquidity.
Oh, absolutely. So look, I think the RBI is doing a good job. It's been pretty cautious. It's being very conservative in its approach. And I think the MPC will do exactly what Sajjid is suggesting. And I'm also glad that Sajjid himself is veering towards being kind of prudent at this point in time and on the hawkish side. But I'll tell you the flip side of the inflation mandate that we have. I've seen enough commentators actually pointing out to the fact that your CPI for August was 3.69%. Your September CPI is projected to be below 4% as well. The last 3 or 4 prints of CPI have been well below MPC projections. And therefore, where is there an issue on the inflation side? We've constantly overshot inflation expectations or projections, and therefore there is no reason to be hawkish right now. I think these kind of inflation blinkers is precisely what we should guard against. One last quick point on the inflation targeting regime. Last fiscal year, FY18, we actually had this beginning of the FX problem already. Our current account deficit went up to $49 billion. Our net FDI came down to $30 billion. We actually had a net outflow of $19 billion. Yet rupee appreciated. In fact, the RBI through the course of the year intervened and bought $44 billion in the market. So where did the $63 billion come in from? It came in because you had carry-seeking inflows coming into the country. So whether we like it or not, there is an impossible trinity. There is a connect between monetary policy, capital flows, and your currency markets that cannot be ignored by just putting on blinkers and saying that multi-factor, objectives is wrong. I agree that you can't be, you can't move from one to the other and pick and choose depending on what Delhi wants, but there is a better way of managing this process. Having said that, look, this debate can happen later. Right now we have a bigger problem with current account, with the fiscal side, and with the state of the financial markets, particularly the financial services industry. Those need to be sorted out first. The debate on monetary policy framework can happen later. But you're right. I think what you're saying is right. I would just make one small difference. I think the system has to ensure that liquidity is available for the credit markets. You don't want the scare that we had a couple of weeks back, where questions were asked about the fund's liquidity, about NBFCs, HFCs, and so on and so forth. You don't want that scare creating a panic, an unnecessary panic that too in the credit markets. So you've got to make sure liquidity is available for good credit. That should not be mixed up with permanent, durable liquidity for money markets and banks, or lower interest rates for risk-free rates. Those are 2 different things completely. I think it's absolutely imperative that we be tight on money market liquidity and on risk-free interest rates. At the same time, ensure liquidity is available in the absence of a proper secondary and repo market for corporate bond markets, and preempt any crisis on that front.
Sajjid, your thoughts on how this liquidity situation needs to be managed, keeping in mind the broader picture? I mean, you're in a tightening interest rate environment, which means you can't lose liquidity, obviously, but if you're in deficit, you can pump in via OMOs, etc. But you should probably avoid doing it via CRR, right? Because that will again confuse the market. Is CRR a liquidity tool, interest rate tool? Old debate.
That's right. I think CRR is just too blunt an instrument here because we're not sure, for what duration we would require it. And and I keep saying this could be a long, dark winter for emerging markets. All of the pressure points that we've discussed would likely get worse before they get better. So you want to keep a lot of your ammunition, a lot of your instruments, a lot of your silver bullets for later. Now, in terms of liquidity, I think, again, there's a well laid out policy that has served the central bank well over the last 2 years, which is we're going to try and keep liquidity, headline liquidity, close to neutral, irrespective of the interest rate cycle. And therefore, last year, even though you got a rate cut in the middle of 2017, the RBI was doing OMO sales to soak up rupee liquidity. I think the opposite will happen this year. Remember, they're not adding liquidity, and therefore there's no inconsistency. They're simply replenishing interbank liquidity when either currency in circulation is high or you are selling dollars and soaking up rupee liquidity. So this is classical sterilization of emerging market central banks, and I'd expect that to continue. Our own forecasts are, given the pace at which cash withdrawals took place in the first 6 to 7 months of this calendar year, and given that the spot intervention this year could be $20 or $25 billion, that just to keep headline liquidity at neutral, one would need significant more injection. And I think it was keeping that spirit in mind that the central bank announced this calendar of OMOs in October. So I think more liquidity will legitimately be needed to fulfill their objective, and that will have the salutary impact that Anand spoke about on the market. So in a way, the existing framework allows for both objectives to be met. Raising rates at the short end, which should hopefully anchor the currency and alleviate concerns on financial stability from that end, and injecting potentially copious amounts of liquidity at the long end to ensure that, as Anand said, you don't have credit conditionings tightening or worsening in the banking system or the shadow banking system. So therefore, I feel the existing framework is sufficient for now.
Ananth, even if that liquidity is provided, as both of you have highlighted, whether it goes through to, say, NBFCs, which were providing the consumer credit, which was then spurring some amount of consumption growth, it depends on a number of other factors as well, right? Would you expect the MPC to take into account that there could be some growth implications of the credit situation we are in right now?
As you mentioned earlier, Ira, I think liquidity is more the domain of RBI directly. I don't think MPC will per se have a discussion around that. But I'm sure between SEBI and RBI and other authorities in Delhi, there's a lot of intense debate happening about how credit situations should be managed. Look, again, I would just reiterate, we've got to differentiate between low rates and permanent liquidity and relief to the banking system versus flow of credit to the NBFCs and HFCs and other good corporates. Look, at the moment, what RBI, I think, is doing is providing ample and copious amount of short-term liquidity. If you actually see the overnight markets, there is ample amount of liquidity actually going from the banks to the RBI on a daily basis. RBI is providing 28-day money and taking back overnight money. So it's hoping, therefore, that by keeping short-end rates low and by keeping short-end liquidity ample, some amount of percolation, I guess, will happen to lubricate the credit markets and ensure there is no panic on that front. I think that's a great strategy. It avoids directly telling banks to fund funds directly against corporate bonds, as it did in 2008 under more extreme situations. If and when, and God forbid it doesn't happen, if you see more panic coming up, at some stage we might have to reconsider the possibility of doing something that happened in 2008. The second part, the flip side, when people ask for CRR cuts or ask for OMOs to bring down rates, I think that would be toxic in the situation. Look, I know every banker, every industry person actually wants lower rates right now and they want relief, and I can completely understand that. But I can give you the example of plenty of countries. I think Philippines is one of them, which actually did a rate hike along with something like a CRR cut. And the currency tanked. Now, we are, given the nature of our external situation right now, if you give mixed signals of being, lax on the monetary front, I think we run the risk of, even more pressure on the currency side. We just simply cannot afford to be lax or see behind the curve as far as the currency is concerned. So provide liquidity, short-term liquidity, but do not bring down yields by doing excessive amount of OMOs. That's not the mandate at all. Do not provide permanent liquidity to the system right now. That's not the route out right now.
But, Sajjid, what are the implications for growth in the sense that, look, already I think after the Q1 number, all of you said that will be a peak and growth will come off. On top of that, you would have had, if you had, say, another 25 basis point hike or a 50 basis point hike, a fairly, steep rate hiking trajectory, and you have credit pressures coming in NBFCs, etc. Would the MPC not want to take account of that when the investment cycle has just barely, started to picking up?
No, I think the MPC will be cognizant of that. As you rightly pointed out, I think the growth impulses, suggests several headwinds, higher oil prices, tighter monetary conditions, maybe a reassessment of risk in the NBFC market so that all that consumption-driven lending, will abate. And that actually may not be a bad thing if you want to try and rein your current account deficit down. But remember, the MPC's mandate, the primary mandate here, and given all the pressures that Ananth has rightly pointed out, is to try and keep inflation close to 4%. So yes, you should focus on growth, but it should matter insofar as it informs your inflation projection. So to the extent that the MPC believes that the peak of growth has been reached, sequentially growth may slow, that would just mean that their 1 year forward inflation projections will encompass that. And all told, the monetary tightening that's expected in the coming months would perhaps be less. So I think that's the way you think about growth. That yes, growth does matter, but you have to first fulfill your primary mandate, and subject to that fulfillment, you have to keep an eye on growth.
Okay. So last couple of questions. One is, Ananth, to you first. So I think the OIS markets were factoring in at least another 50, some were saying 75 basis points of rate hikes from here. Is that an overstretch then, given everything that we've discussed, both on the implications of growth of various factors, plus, while inflation currently is running below the forecasts?
Well, this is, after a long time, I'm seeing an MPC where a whole range of possibilities are being discussed. I've heard people saying there'll be no rate action whatsoever. I've heard people saying 25 and neutral. I've heard 25 and hawkish. And I've also heard 50 basis points. So, take your pick on what you like as a choice. Couple of quick points. I think I would expect a conservative RBI and the RBI members on the MPC to actually push for a hawkish policy at this point in time. While it will be painful and, any demand contraction is going to be painful. But given the nature of our financial stability, given the nature of our currency market situation, we cannot afford to be seen behind the curve. RBI enjoys a tremendous amount of credibility because it's been conservative in the past. I think we've got to capitalize on that. So I do think they will err on the side of being hawkish, but we'll find out in God's good time on the 5th. Even if they don't deliver on a hawkish policy, if they are, let's say, the people calling for a no rate hike and therefore the OIS market is wrong kind of situation, I suspect we will see an immediate negative reaction, especially in the currency markets, which could percolate to other markets as well. So I'm really not sure if just a no rate hike can actually translate into lower yields at this point in time. Remember that, the yield markets have gone up, the interest rate markets yields have gone up quite sharply even before RBI took any policy action. It's not here at 8% plus or 8.1% 10-year bonds because RBI has hiked repo rates. That's just 6.5%. Clearly, the market is nervous, and the lesson or the message coming from the market has to be kind of paid cognizance to.
Okay. Sajjid, last question to you, and I'm tacking on two questions in this final question. One, of course, is would you also expect them to drop neutral, do a rate hike? But would you also expect, or do you see any need for the RBI to consider extraordinary measures either on the currency side in the nature of an oil window or FCNR, etc., or on liquidity in the nature of a special window for mutual funds or some sort of refinancing for NBFCs? Is any of that within the realm of requirement right now?
So on the first question, I think it's important, and I think policymakers need to be credited in this environment not to overreact, not to show knee-jerk reactions, not to reveal any panic, because A, this is a systemic problem, and B, this could be a long-standing problem. So you really want to conserve your buffers for later. which is why I think the RBI should stick to the script, focus on its existing mandate, raise rates by 25 basis points. I would think the time has perhaps come to change your stance from neutral to a withdrawal of accommodation for a variety of reasons. One is that the risk bias has clearly changed. I mean, the neutral stance was meant to convey that the next move could either be a cut or a hike. No one now legitimately expects that the next move to be a cut. So number one, the risk bias has changed. Number two, when you raise rates in 3 successive meetings, then that's much more consonant with a tightening bias. And number three, I think raising by 25 basis points and changing your stance would convey the signal to markets that the RBI is prepared to do what it needs to do in the coming months, and that could have a salutary effect on markets. So I would expect 25 and a change of stance. I think it's tempting to kind of talk about extraordinary measures, but again, there's just so much global uncertainty. In the last 15 days, oil prices have gone up 10%. The trade war has escalated. The Fed is with every policy becoming more hawkish. So this could be an extended period of stress, and I think it's always important for policymakers to have some silver bullets in their back pocket, and for markets to know that there is a silver bullet so as to rein in expectations. So I think it's a bit premature at this point for the RBI to talk about extraordinary measures. You want to save that if the stress were to continue, and you don't want to use multiple things at the same time. Let's start by having a conservative policy, raise rates, change the stance, see what that does to market movements, and then leave some of these other measures for later.
All right, Sajjid, Ananth, thank you so much for helping us set the stage for this very interesting and complex Monetary Policy Committee meeting. That's the view from our panelists. Hawkish policy is possibly expected, but certainly warranted. Thanks so much for watching Bloomberg Quint.